What if the greatest wealth-building secret in history was never about picking the right stock at the right time, but about getting paid to wait? Every day, millions of people stare at stock charts, trying to predict the next move. They watch the ticker, they read the news, they buy and sell and buy again. But the wealthiest investors in American history, they weren't watching the ticker. They were watching the mailbox. Because every quarter, without fail, a check arrived. And then they did something almost no one else did. They bought more. Chapter 1. What are dividends and why do they matter? A dividend is a payment a company makes to its shareholders, a portion of its profits, distributed on a regular schedule. It sounds simple, almost boring, but embedded in that simplicity is one of the most powerful forces in finance. When a company earns money, it has a choice: reinvest those profits back into growth or share them with the people who own the business. Dividends are the share. They are a company saying, "We made money and you helped us do it. Here is your cut." The history of dividends stretches back centuries. The Dutch East India Company, the world's first publicly traded corporation, paid dividends to its shareholders beginning in 1602. 400 years ago, ordinary investors were receiving passive income from a business they helped capitalize. The principle hasn't changed. The scale has simply grown beyond anything those early merchants could have imagined. Companies that pay dividends are making a statement about their confidence in the future. They are saying, "We generate so much cash that we can afford to return some of it to you while still growing." That signal matters. It is one of the most honest indicators of a company's financial health. Chapter 2. The mathematics of compound growth. Now here is where it gets interesting. Imagine you invest $10,000 into a company that pays a 4% dividend yield. In year one, you receive $400. Most people take that cash and spend it. But what if you reinvested it? You now own slightly more shares. Those shares pay slightly more dividends. And the cycle begins. This is called drip investing, dividend reinvestment plans, and it turns a gentle stream into a river. Over 30 years at 4% yield with reinvestment, that original $10,000 doesn't just double. It grows to nearly $32,000 without you adding a single penny. Now add regular monthly contributions, even modest ones, and the numbers become extraordinary. An investor who puts $500 per month into dividend stocks, starting at age 25, reinvesting every payment, can accumulate well over $2 million by retirement. Not through luck, not through perfect timing. The real secret is time. The math of compounding rewards patience above everything else. A 25-year-old who invests consistently and reinvests every dividend will outperform a 45-year-old who picks the perfect stock 9 times out of 10. Because the 45-year-old doesn't have the most valuable asset in investing: time. Albert Einstein allegedly called compound interest the 8th wonder of the world. Whether he said it or not, the math is irrefutable. Given enough time, dividends don't just supplement wealth, they become wealth. Chapter 3. The historical record of great dividend investors. John D. Rockefeller didn't just build Standard Oil into the most powerful corporation in American history. He structured his wealth to produce income forever. As Standard Oil paid enormous dividends throughout the late 1800s and early 1900s, Rockefeller reinvested obsessively. When the government broke Standard Oil into 34 separate companies in 1911, Rockefeller owned shares in all of them, and all of them paid dividends. His income actually increased after the breakup. His wealth at peak was estimated at over $400 billion in today's terms, built not on timing the market, built on owning companies that paid him to hold. Warren Buffett built Berkshire Hathaway into one of the greatest wealth creation vehicles in history through a similar philosophy. His largest holdings, Coca-Cola, Apple, American Express, Bank of America, all pay dividends. Berkshire itself received over $6 billion in dividends in a single recent year from its equity holdings alone. $6 billion, arriving quarterly without Buffett having to make a single trade. Today, a select group of companies are known as dividend aristocrats, S&P 500 companies that have increased their dividend payouts every single year for at least 25 consecutive years. Think about what that means. Through the dot-com crash, through the 2008 financial crisis, through a global pandemic, these companies kept raising their dividends. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, they are the iron backbone of dividend investing. Businesses so fundamentally sound that they returned more money to shareholders every single year, regardless of what the economy was doing. Chapter 4. How to build your own dividend portfolio. So how do you build your own dividend portfolio? The first rule, don't chase yield. A 10% dividend yield looks incredible on paper, but if the company can't sustain it, that yield will be cut and the stock price will fall with it. Smart dividend investors focus on three things. First, the payout ratio. What percentage of earnings is the company paying out as dividends? Anything above 75% is a warning sign. Second, the track record. Has the company consistently paid and ideally grown its dividend over time? And third, the business quality. Does this company have durable competitive advantages that will let it keep generating cash for decades? Think about what makes a truly great dividend stock. It is a business with pricing power, one that can raise prices without losing customers. It is a business in an industry that won't be disrupted out of existence. It is a business that generates more cash than it needs to operate. These are the companies worth holding for 20 or 30 years. These are the ones that will be quietly depositing money into your account long after you stop thinking about them. Diversification matters here more than many investors realize. A concentrated dividend portfolio in one sector is dangerous. Utility companies, for example, were beloved for their high dividends until rising interest rates made those dividends less attractive, and the entire sector fell sharply. Spread your holdings across sectors: healthcare, consumer staples, industrials, financials, real estate investment trusts. Let no single position, no matter how much you love it, make up more than 10% of your income stream. Chapter 5. The mistakes that destroy dividend portfolios. The most common mistake, selling during a market downturn. When the market falls 20 or 30%, the dividend investor's instinct is often panic. But here's the counterintuitive truth. A falling market is the dividend investor's greatest opportunity. Your shares now cost less. Your reinvested dividends buy more shares. And when the market recovers, you hold more of the asset that keeps paying you. The second mistake is ignoring dividend cuts. When a company reduces or eliminates its dividend, it is sending a signal. Management knows the future better than analysts do. A dividend cut is not a buying opportunity. It is a warning. Pay attention. The third mistake is impatience. Dividend investing is inherently boring, and that is precisely why it works. The investors who get rich this way are the ones who stop checking every day, stop reacting to headlines, and let time do what time does best. The 100-year secret of dividend investing is not complicated. Find great businesses, own them, reinvest what they pay you, wait. The market will test your patience, it always does, but the dividends will keep arriving, quarter after quarter, year after year, and one day, you'll realize the mailbox was more powerful than the ticker, all along. If this changed how you think about building wealth, subscribe to Market Mapped. New deep dives on investing and financial strategy every week.